of Finance with Excel Modeling, copyright Lou Gaddis. Topic 2, the cost of capital, WACC, cost of debt, and cost of equity. Cost of capital refers to the rate of return required by providers of capital, both debt and equity. Increasing the value of the firm requires you to make investments with a rate of return that exceeds the firm's cost of capital. In this topic, we're going to calculate the cost of capital by first calculating the cost of debt using several methods, calculating the cost of equity using CAPM, and then computing the weighted average cost of capital. So WACC, the weighted average cost of capital, is the firm's cost of capital. It is the required return that owners and investors in the company have made. When we talk about capital, we talk about either debt or equity. When we talk about debt, we're talking about loans or bonds. The funding cost from the company's debt holders is called the cost of debt, usually written KD or RD. Interest payments paid to the bond and loan holders are tax deductible for the corporation. So we talk about the after-tax cost of debt. What it actually cost you to pay off after taxes is the cost of debt times 1 minus the tax rate. Bonds, which are going to be covered later in this topic or later in this course, are loans made to the corporations, and they're going to be discussed in the last quarter of the course. Now, equity, when you think of equity, think about stock. The funding cost from the company's owner is called the cost of equity, either written KE or RE. Now, stocks represent fractional ownerships of a company. So, for example, Walmart has about 3 billion shares. If you own 1 share of Walmart, you own 1/3 billionth of the company, which entitles you to get a dividend if it's paid and to vote on certain items or decisions the company makes. However, dividends are not tax deductible, so the cost of equity is not affected by the tax rate. So the weighted average cost of capital, it's literally the weighted average of the cost of equity and the cost of debt. So we write that as the cost of equity times the percent of equity financing. Now E is the total market value of all these stock or equity investments in the company. D is the market value of all debt. Now I will give you a caveat that calculating the market value of equity is pretty easy. You just take the total number of shares outstanding, multiply times the market price of each share. That'll give you the E. The market value of the debt is almost impossible to get, so we usually, as a proxy, will use the book value of debt from the balance sheet. So that's the share of equity financing times the cost of equity financing. And then we're going to have the share of debt financing, which is D over E plus D, times the after-tax cost of debt. So here's a quick example on how to calculate it. So I'll go to my starting file, and we're going to calculate the weighted average cost of capital from United Transport. So let's assume that the cost of equity is 20%, the cost of debt is 8%, tax rate is 40%, there are 3 million shares outstanding, the market price of each share is $10, and the market value of debt is $10 million. We'll first calculate the market value of all equity. $10 a share times 3 million shares, that's $30 million. That's also called the market cap of the firm, the market cap. If I add the value of equity plus the value of debt, that's the total capital of the firm. If I divide my equity capital by the total capital, the firm is financed with 75% equity. And if I take 1 minus that, it's financed with 25% debt. So I can calculate my weighted average cost of capital. It's going to be the cost of equity times the weight of equity. So I'll take my 75% of 20% plus my weight of debt times the after-tax cost of debt. So I'll multiply that times KD times 1 minus the tax rate. So United Transport has a WACC of 1620. That becomes a very important number for the firm. If the firm is considering doing projects in which have the same risk as the existing firm, they have to get a 16.2% return. Otherwise, they will not be able to pay off their capital providers. So there's the solution. Now we're going to calculate the cost of capital for a real-life example, Walmart. Stock symbol WMT. Now there's going to be 3 different ways we're going to talk about calculating the cost of debt. One is actually looking at bonds long-term bonds of the corporation and taking maybe the average of some long-term bonds. We'll also look at what is the average yield on bonds of firms with similar risk as measured by credit ratings. We could use that as a proxy for the cost of debt for a particular firm with that level of risk. And lastly, we'll go to the income statement and divide interest expense divided by total debt. So that would be the historical rate from last year. So let's first look at Walmart. I went to Morningstar. It's a free website. Clicked on Walmart, selected bonds. And what I saw is I went down the list here. Here's a listing of it's like a bubble chart here of Walmart's bonds. It's probably the circles are probably related to the size of the amount of the borrowing. And what you see is their long-term financing seems to be kind of close to 4%. And I went down here and calculated the yield, or used the yield, which is a measure of the current rate of return of those bonds. And we see, if I take the average of, say, these last 3 bonds, it's about 3.76% yield. So I could use that as a measure of what Walmart's long-term cost of capital is for debt holders. Now notice, if you do this, don't use the coupon rate. All right, that's the stated rate that makes payments on the bond. However, these bonds prices have changed because over time interest rates change and risk characteristics change. So we always want to use the yield or yield to maturity or YTM of the bonds. That gives me an indication of the current cost of debt. So that's going to be one measure, 3.76. Another way to do it is I looked up Walmart. Actually, on the last website, it said it was a AA rated firm, and I went to the S&P website and saw that indeed it was rated AA for their long-term debt. So the rating from the S&P company, the S&P Corporation is a ratings agency. There are 3 main rating agencies, S&P, Fitch, and Moody's, and each of them have some kind of schedule or rating. So the AAA, for all 3 ratings, AAA is the highest rated bonds. And those are the bonds with the least likely to fail. Now, these are only a few corporations that get this, and some very safe government bonds get AAA ratings. So Walmart is a AA rated bond, which is one of the highest rated bonds out there. So what that tells me is it's very unlikely to ever default. Now, if you look at the credit ratings for all the rating agencies, they do make a split. Even though they go from AA to or AAA to AA to single A to Bs to Cs and Ds, all of them kind of use that schedule. There is a difference between bonds above this line and below this line. Anything above, say, in S&P of a BBB minus, that's considered investment grade, which means they're very low probability of default. And the least probability would be the AAAs. The junk, or sometimes called speculative bonds, or bonds with significantly more risk than the ones above the line. So we talk about investment grade bonds, and we talk about junk or speculative bonds. Now, Walmart, based on their the S&P and Fitch and Moody's assessment of their business risk and their strategy, and looking at things like their debt to equity ratio and times interest earned ratio and quick ratio, they look at all those factors and they determine that Walmart is a AA rated firm. Then I went to Yahoo Finance, looked up bonds, composite bond rates, and what you have is corporate bonds. And what you see is 20-year, I just found a long-term corporate bond, 20-year AA bonds. So those are bonds that have the same risk as Walmart, as assessed by the rating agencies, have a 387 cost of debt. All right, that's actually what I'm going to use for my WACC calculation. So even though these bonds are Walmart's exact bonds, this tends to be more stable. Also, we don't really know exactly. There might be special terms in these bonds we're not aware of. There might be provisions for the bond to be called back early, so it may not be as long-term as we think. It might be provisions to have these bonds have collateral, meaning they're attached to certain properties if it goes into default. So I'm not really sure exactly what these bonds are unless I really looked up the actual terms of the bonds. So this is probably a safer way to calculate the cost of debt, is get the rating agency for a company and then look it up. What is the average yield for that firm's long-term bonds? Now, the last thing you can do is actually look at the interest expense on the balance on the income statement and divide by the average debt balance over the last 2 years. You would think that this would be better, but I generally consider this to be my last resort method for a few reasons. One is that interest expense and the debt balances don't distinguish between short-term and long-term borrowing. So the firm may have a lot of short-term, very low-rate bonds right now, but it has to turn them over, say, next year, and meaning pay them off and get new bonds at a higher rate. Also, it doesn't count for the debt retirements that show up on the year-end balance sheet. So what that means is the interest expense from the from the year-end financial statement, the interest expense is for the full year, but the debt balance is from just the year end. So that interest expense may be a bond that matured in January, so it's really 1 month's interest, or it could be a bond that matured, say, December 20th. So it's almost 12 months interest. So just by dividing the interest by the average debt balance, you don't really have an idea of what the yield on the bond was because you don't know when some of those bonds actually matured or were issued. Also, just like same reason I don't like using individual bonds, the interest expense may be due to certain terms of the bond that may influence its yield. And lastly, when you look at a lot of times, if you look at the financial statement and look at the interest expense on the income statement, it doesn't break out between interest income and interest expense, right? Firms generally have bonds outstanding in which they pay interest, but they also generally have investments in which they gain interest. And what gets reported is the net interest income. So by just dividing the interest, or the net interest expense, I should say, by the debt balance, you may actually be intermingling in there some of the interest income, which would then understate your actual rate. So historical expense should be a last resort. So I'm going to use 387 as my forecast for Walmart's cost of debt. Now, cost of equity is going to be the trouble, one. The problem with cost of equity is it's difficult to forecast in the future. There's no stated return on stocks like there are on bonds. Now, while you can forecast, or historically you can see what the return of a bond was historically. So say say a stock ended with P1, price P1. Say it was priced at $110 at the end of the year and started the year at $100. That's a $10 capital gain over last year. And if it paid, say, a $5 dividend, well, I made $10 capital gain and a $5 dividend. And if I divide that by the initial price, that's the rate of return for that stock for last year. However, there's no observable or stated future rate of return. That's because dividends are not certain. In fact, many companies pay no dividends, and the future stock price depends on a lot of factors. It could be the bottom line growth, the top line growth, strategy of the company that's just announced, a change in the competitive environment, or just the overall market sentiment is going to change that P1. So it's largely unpredictable. So the way we're going to calculate what the expected or required return of a stock in the future is going to be is we're going to resort to one of the more famous models in finance. It's called the Capital Asset Pricing Model, or CAPM. CAPM is a model that relates the expected return of the stock to its market risk. So let's talk about CAPM for a minute. CAPM's biggest assumption is that most investors are rationally diversified in many stock. Therefore, no one is silly enough just to own one share of Walmart. What they own is Walmart in combinations with hundreds of other stocks. Therefore, they're rationally diversified. Therefore, if you want to talk about the risk of a particular stock, it can only be measured in the contents of a larger portfolio. So we don't measure risk. So let's think about this for a minute. If every investor owned just one stock, the risk measure that most likely I would use would be standard deviation. If I only owned Walmart stock historically, I can go back in time and see how volatile it was and see how risky it was. So that's sometimes called the total risk. However, if I hold Walmart in a portfolio, I can just look at a very large portfolio, say the S&P 500, which is a collection of the 500 largest companies in America, or 500 of the largest 5 companies in America. The measure I'm going to use is the incremental risk that particular stock added to my diversified portfolio. That measure is called beta. All right, so it's not going to be standard deviation. It's called beta. Now, how you calculate beta? You're going to run a regression. So here's a Bloomberg screen that has Walmart's return on the y-axis and the market return on the x-axis. And each dot represents a particular date. So on this date, Walmart's return looks like it was about 7 or 8%. The market return looks like it was around 1%. So each date represents a point where you have a market return and you have a stock return. And if we fit this data with the best fit line, the regression line that minimizes the squared deviations from this line, the slope of this line we call beta, and it gives us a measure of how sensitive that stock is to the overall market. So we're going to actually calculate or use historical data, download historical returns of the market and Walmart, and we're also going to then calculate the slope of that best fit line. All right, now the CAPM formula gives this exact formula, or the CAPM model gives this exact formula. The cost of equity, the expected or required return of equity, that's what that KE means. It's the risk-free rate. Now I'm going to use the long-term treasury yield as the risk-free rate. So it's the risk-free rate plus a compensation for risk. That's what this last term is. So every risky asset pays at least the risk-free rate plus a compensation for risk. That risk is measured by beta. That beta is that regression coefficient between the stock's excess returns and the market's excess returns. And here's the compensation for risk. It's the expected return of the total market, RM, minus the risk-free rate, our treasury rate. So what I need to do is look up the treasury rate, long-term treasury rate, have an estimate of the expected return of the market, or have an estimate of the expected return of the market over the risk-free rate, which is called the market risk premium, and then calculate a beta. So that's what we're going to do. Now the risk-free rate on May 13th, 2016, I looked in Yahoo Finance and got the 10-year treasury yield was 1.7%. So that's what I'm going to use. Now, so I got this number here, it's 1.7%. Now I'm going to estimate this value. What is the expected return of the market minus the risk-free rate? Well, the first thing I would look at is the historical data. If you go to Aswath Damodaran's webpage, he's at NYU. He has some free data that's updated frequently, and he shows from 1928 to 2015, the stock market returned almost a little over 6% over long-term treasuries. However, in the last 50 years or so, it's only been about 4%. So that's generally the range. If you're going to use historical data, depending on what sample you're using, you're generally going to use a market risk premium of 4 or 6%. Now, Damodaran also estimates a forward-looking market risk premium, which looks at the current value of the stock market and backs into the market risk premium. He's also getting about 6%. All right, so most people use between, say, 4 and 6, or at the higher end, between 4 and 8%. So for our analysis, we're going to use a market risk premium of about the 100-year average of about 6%, which is also equal to Damodaran's forward-looking estimate of the market risk premium. So if treasuries are currently 1.7%, and we estimate that the market, the stock market, total stock market, is going to yield or return about 6% above that, that means my estimate for the stock market is about 7.7%. And this method, this line of thinking allows you to think about what is my expected return on stock markets. And this is probably a reasonable guess, about a little over 7 or between 7 and 8%. All right, so now we have our risk-free rate, 1.7. We're going to estimate this to be 6%. So now we're going to calculate the beta. Now, if I solve the CAPM formula for beta, what you see is the beta is the ratio of the returns on the stock minus the risk-free rate, called the excess returns of the stock, and the excess returns of the market, which is the returns on the market minus the risk-free rate. So when we calculate this beta using historical data, if that beta equals 1, what that means is that the stock has about the same risk as the market. More specifically, what it means, if the market is up 10% and the beta is 1, your stock is expected to be up by 10%. Now, if your calculated beta is greater than 1, say your beta is 2 for Walmart, that means that you have twice the risk as of the market, which means if the market is up 10, you'd expect your stock to be up by 20. Or if the market's down by 10, you expect to have the stock be down by 20. So it's twice as risky. And if the beta is less than 1, that means the stock is less riskier or less risky than the market. So if the beta is 1/2 and the market is up or down 10%, that means your stock is only up or down 5%. So I went ahead and I downloaded 5 years of monthly prices for Walmart, symbol WMT from Yahoo Finance, the S&P 500, symbol HAT GSPC, and the 10-year Treasury yield, symbol HAT TNX, all from Yahoo Finance. Now the S&P 500, the Standard & Poor's company that does the ratings, they also publish an index of roughly the 500 largest stocks in America. So when we talk about the S&P 500, we'll talk about that as roughly being the U.S. stock market, a proxy for the U.S. stock market. Now there are thousands, probably 5,000, 6,000, 7,000 stocks in the U.S. These 500 companies historically have made up about 80% of the total value of all U.S. stocks. So I've done this download for you, but to give you an idea, I went to yahoofinance.com. I typed in Walmart stock symbol, WMT, at the top of the page. I then clicked on historical prices. I selected a date range. I'm going to do May 2011 to May 2016. I selected monthly prices, and I downloaded the data into Excel, and all I captured was the adjusted close price. So let me just take a minute to talk about adjusted close price. The close price is the actual price of the stock that closed on that day in the market. The adjusted close price makes an adjustment for dividends. So if on one of these periods the stock paid a dividend, what would happen is the price, this adjusted close, will reflect the dividend. So for example, if the stock paid a $1 dividend on a particular date, what would happen is the adjusted close would go up by $1. Therefore, you can use the adjusted close to calculate the total return of the stock, not just the capital gain. Otherwise, I'd have to collect all the price information and the dividends. So here's the data, and let's go ahead and calculate our betas. So I'm going to go to my Walmart WACC page. These are the adjusted close prices from May 2016, 2011 for the S&P 500, Walmart, and then these are annualized Treasury yields. So first thing I'm going to do, I want to calculate the monthly return of the market and Walmart. So I'm going to take Walmart's closing price in May minus Walmart's closing price in April divided by Walmart's closing price in April. So that's our percent change formula, new price minus old price over old price. Whoops, we're actually doing the market, so I'm going to slide these over here. So the monthly return of the market is the new price of the market minus old over old. So the market in May of 2016 from April of 2016 was down 0.04% or 4 basis points, as they say in finance. In finance, 100 basis points is 1%. So 0.04% is 4 basis points. I'll then copy this over here. This is my return of Walmart for the month of May or April. And then since Yahoo Finance gives me the annualized 10-year yield as a whole number, I'll divide that by 100. So now you see that the annualized yield on the 10-year Treasury is 176 basis points or 1.7%. But I want to make all of these monthly, so I'm going to divide by 12. So that would be the monthly return on Treasury. So now I have the monthly return of the market, Walmart, and Treasuries. I'll then take the market return minus the risk-free rate, and the Walmart return minus the risk-free rate. All right, now remember the reason I did that is because beta is the relationship between the excess returns of the stock and the market, meaning you subtract off the risk-free rate, solving our CAPM formula for beta. Now I'm going to take these cells. I'm going to double click here to autofill it down to the bottom. But then I'm going to delete off the last row because I run out of prices, right? So I have about 60 prices here, but I can only get about 1 minus that 59 returns. So now I have the market and Walmart's excess returns. The first thing I want to do is actually want to do a graph. I know if I highlight two columns where I have the first column be an X variable and the second one be a Y variable, if I highlight that column and I select it, I'll go back up here, and I'm going to insert a graph, and I'm going to do an XY scatter. What this graph shows me, this is Walmart's return on the Y-axis, the market's return on the X-axis. So I'm looking at this month right here. This month had Walmart's return at 6.63% and the market's return at about 1%, 1.14. So each dot represents a month return. Now if I click on a dot here and do a right click, I can add a trend line. And what I'm going to do is just use this linear trend line. And I'm going to ask it to display the equation, and I'll close that. So what this tells me is this data shows that the trend line is equal to the regression line, or regression equation is y equals 0.218 times x plus a constant 0.0034. Now y is the excess return of Walmart. X is the excess return of the market. So what this says is historically the return on Walmart is 0.218 times the return of the market. I'm going to put that over here. So that number, that 0.218, is the beta over the last 5 years. Now we can do beta a few more ways. We also could have just run a regression. I can go to data, data analysis, regression. Now data analysis is an add-in. You might have to go to file options, add-ins, and add data analysis as an add-in. I'm going to run a regression. It asks for the Y range. Now Y is the Walmart. I'm going to start with the name Walmart, that label. I'm then going to put in the market as my X variable. I'm going to click on label since my first cell included a name. And I'm going to go to output. I'll just paste it right here. And I'll hit go. There's my exact beta or slope of the regression line. So I can make that an input. And that could be my beta for Walmart. So I could use that beta. And I'll link it here too, since I have a cell here that says the beta from 2011 and 2016. So if I use this beta, it has a little more decimal plates, I'll show them places. If I use this beta, I can plug in my CAPM formula. The expected return of a stock is the risk-free rate plus beta times the market risk premium. So the Walmart expected return, or required return based on CAPM, is it provides 1.7% the risk-free rate plus a compensation for risk equal to the beta times the market risk premium. Now that looks like a pretty low number, for a stock to provide only a 3% long-term return. And if we look at the beta, we can kind of see what's going on. Now I already have formulas built in here. This is the full beta from 2011, 2016. Let me show you one other way to calculate that. This is actually the way I do it when I did it, because it's the easiest way to do it. Excel has a function that calculates regression slope, the slope of the regression line. It's just equal to slope. So I can just say equals slope. Y is always the stock. So I'll put the stock's returns, comma, the market's returns. Close that out and hit enter. That's the easiest way to get the beta. But then I have these formulas built in. Here's just the slope for 2015 and 2016. I'm sorry, and 14 and 13 and 12. So you see the beta has been very variable. It's been as low as negative 0.6 and as high as 1.07, which has a tremendous implication on our cost of equity, right? If that beta is 1.07, our cost of equity is 8.13%. So I'm going to hit undo. So I'm going to show you, so that it's real dangerous, or can be dangerous or volatile estimating historical betas. So I always kind of have a look if these are not, or if it's really varying from that 5-year average. I'm really concerned about using historical betas. So I'm going to show you one other method for calculating beta. And that is, I'm going to look at the beta, or the betas for the average firm in Walmart's industry. It's going to be much more stable. So I'm going to calculate the historical beta for Target and Walmart and Costco and many other stores. I'm going to use their beta and use that as an estimate for Walmart's, and with the assumption is there's basic risk to doing retail and groceries, and that risk is captured through an industry beta, and it's going to be much more stable. Now the problem is all those firms I just mentioned have the same risk, right? They face this retail business risk. However, all those firms have different capital structure, which means they have different levels of debt, which then creates more or less risk than just the business risk. So DeModern, again, our NYU researcher, publishes, and you can probably get this from a Bloomberg pretty easily, publishes betas for an industry if those companies had no debt. And how they calculate it is they calculate the betas just like we did. However, to calculate the beta, if the firm got rid of all its debt, we take the beta that we calculated. We call it the levered beta because presumably all the firms that we were looking at have some debt. So we calculate that historical levered beta and divide by 1 plus the after-tax debt-to-equity ratio. That would tell us the beta if the firm had no debt. We call that the unlevered beta, or the all-equity beta. Now, Walmart's an interesting case. I looked in Walmart's financial statements. 50% of their revenue comes from general retail, and 50% of their revenue comes from retail, grocery, and foods. So the retail beta is 0.92, the general merchandise beta. The grocery beta is 0.77. So for Walmart, again, this is just a special case. I'm going to take, they're basically half a retail merchandiser and half a grocery store. So I'm going to take half the 0.92 and half this 0.77, and I'm going to get an unlevered beta of Walmart of 0.85. That gives me a beta of what Walmart's risk is, assuming they have no debt and assuming they have the same risk as the industry. Now, what I'm going to do is I'm going to use that same formula here. So if I'm going to solve for the beta, levered beta, that's what this is. And what I'm going to do is take that beta, that unlevered 0.85 beta, and lever it by multiplying times 1 plus the after-tax DDE ratio. And that'll give me Walmart's beta if they have the same risk as their industry but have their specific financial risk using their DDE ratio. So I collected some data here. Walmart's market cap is $204 billion. They have $50 billion of debt. That'll give me a DDE ratio. And I also looked up their tax rate. Last year they paid 30.3% in corporate taxes. So let's go ahead and calculate the beta of Walmart. So what we said is their unlevered beta was 0.85 from DeModern. They had $204 billion of debt. They had $50 billion of debt and $204 billion of market cap of equity. Their tax rate was 30.3%. That gives me a DDE ratio, D over E, of 0.25. Now I can lever the beta using my formula, the unlevered beta times 1 plus the DDE ratio times 1 minus the tax rate. So Walmart, redo that. It's the unlevered beta times 1 plus the DDE ratio times 1 minus the tax rate. And I get a beta of 1, which actually makes more sense to me. Walmart is almost as big as the economy anymore. Now I can calculate the cost of equity using CAPM with a beta of 1. Risk-free rate plus beta times the market risk premium. That gives me a cost of equity of about 7.68%. Let me just talk a minute about what that means. Last time I did this, I got 7.65%. I guess it's rounding. So what that means, if CAPM says your cost of equity is 7.65%, and the current stock price is $60, that doesn't mean the stock price is going to grow, is expected to grow by 7.65%. It only means that if the stock pays no dividend. But Walmart pays a dividend of 3%. So if the model is telling me the total return of Walmart is going to be 765, if I take out the 3% the shareholders are going to get from the dividend, that means it's only going to grow by 465, or the stock price is going to go to $62.79. So we can now calculate our WACC. The WACC is going to be the weighted average of our cost of debt and cost of equity. So I'm going to take my cost of equity. I'm going to use my 7.65%. My cost of debt, I'm going to use, well, I think we decided we're going to use 3.87%. I have a debt percent. I'm going to take my value of debt divided by my value of equity. I'm sorry, take my value of debt divided by the value of debt plus equity. That's the total amount of debt in financing. I'm going to take 1 minus that. So Walmart is financed about 20% with debt, 80% with equity. And now I can calculate my WACC. 80% of equity, or 80% financed with equity times the cost of equity, plus 20% of debt times the cost of debt, times 1 minus the tax rate. So I get a WACC of about 6.7%. Now you might be concerned, we had to make a lot of assumptions on cost of debt and beta and the market risk premium. So you might want to lastly thing to do is calculate a little sensitivity analysis. So let me just show you how to do a two-factor data table, that's sensitivity analysis. Now I just typed in these numbers here. What if the unlevered beta were between 0.245 and 1.045? Right, so that's my range of betas. And what if my cost of debt were between 327 and 447? So you just type these numbers in. I can then, I got to change this cell here since I currently have it as a white text. I'll change it to red text. I'm going to put a formula here that has my WACC, that points to my WACC. Let me cut down on decimal places here. So that's just a link to my WACC. And then what I'm going to do is I'm going to see how I'm going to highlight this range. Try that again. I'm going to highlight that range and go data, what if, data table. Now my cost of debt is in a row, and this answers for the row input. So I'm going to find the debt that I used that drives this WACC. Right, this debt is used, cost of debt is used in this WACC. Now the column is the beta. I know that this unlevered beta drives this cost of equity, which drives this WACC. So now I can hit OK, and now I have a range of WACCs. All right, and it looks like my WACCs go from 320 to 788 based on my range of assumptions. So this allows me to do a two-factor sensitivity analysis on WACCs. All right, so there we go. That's how you calculate the weighted average cost of capital for a company and do a two-factor sensitivity analysis for a table. So remember, cost of capital is the return required by the capital providers of the firm, both debt and equity. It's an incredibly important number for a firm because that cost of capital then determines as kind of a hurdle rate that every project in that firm must have, its return must exceed that, otherwise it can't pay back its capital providers. So in this topic, we computed the cost of debt using several methods: historical returns, a credit spread, and then we also looked at the actual yields on bonds. We calculate the cost of equity using CAPM, and then we calculated the weighted average cost of capital.